Hey everybody, this is home loan expert Dan back with another mortgage explainer. And today I think we're going to be covering a topic a lot of people have questions about, and that is when does it make sense to refinance my mortgage? All right, so I'm not going to go into all the little nuances of how you can structure a refinance. There's a lot of things to really get into. In this video, I just want to answer the main question and at least point out things that you're going to want to be aware of when trying to think of that answer for yourself. Does it make sense based on the terms, the rate that I'm being offered with this refinance compared to my current loan situation? Does it make sense for me to do this refinance? What's the savings? Is there a break even point based on if there's closing costs? So let's just kind of dive into it. I'm going to break down an example that I put together here for us. Now, it's important for me to say I'm not advertising this example to anybody. I'm not advertising a rate, program, product, nothing. Okay. This is just to go through together to gain a better understanding, to say, okay, here's where I'm at. What should I look for with my current loan? And then with what I'm being offered here on the refinance, what are the things to look for to see if it makes sense? Okay. So in this example, I put together that let's just assume at the time that this person purchased a house, they have a starting loan amount of 300,000. And we're also going to assume that their interest rate is 7.5%, and that this is a 30-year fixed rate mortgage. Okay, there's no prepayment penalty. They can pay as much as they want, refinance at any time. And their starting principal and interest amount, assuming these terms, is 2,097 and 64 cents. That's not including taxes or insurance. In that, no mortgage insurance, nothing is being taken into consideration here. We're just looking at the principal and interest with what they have in this loan. Now, it's rare that this is going to happen, but at the bottom I put if you made it the minimum payment over 30 years, after 30 years, this person would have paid $455,151.67 in interest over the life of that loan, right? Minimum payment over 30 years. That's what you're going to pay in interest for this loan. Okay, so let's keep these things in mind. And I did put together too an amortization calculator showing these exact same things. Again, we can enter it in here, and I'll show you at the end where you can access an amortization calculator as well and give you a better understanding of what these numbers mean. Okay, so we enter in the loan amount. So we said 300,000, interest rate 7.5%. It's a 30-year mortgage, fixed rate. You make one payment every month, so you make 12 payments throughout the year. And we're going to assume that this person maybe took out the loan a year ago. So with the scheduled payments, again, the principal and interest, $2,097 over the life of the loan. 455,000 is being paid in interest. Okay, so that's what we just went through. Here's the amortization calculator showing that. Now let's say 2 years pass from when this person took out that initial loan. And some of the things, if they made the minimum payments for those first 2 years, are going to show that the remaining loan balance, 294,254. And again, that's because in the beginning of your loan, when you have the highest balance, you're paying more in interest at the start of that loan compared to when you're making your payments more towards the end. Your loan balance is a lot lower, and so the amount of interest you're paying is a lot lower towards the end of the loan. Okay, so after 2 years, if they make the minimum payments, they've only paid down, just over $5,000 off that principal balance. So 294,254 would be the remaining balance in this situation. The remaining interest would be 410,553. The remaining months would be 336, right? They only paid 2 years, 24 months off the beginning term. Now let's say that somebody comes to them and says, okay, I can offer you 7% on a new loan. Originally, you're at 7.5%, or this person's at 7.5%. So it's only half a point. And I use this specifically because I think a lot of us have heard, or at least I've heard in my business, a lot of clients ask me, well, do I have to save at least 1% to refinance and have it make it worthwhile? I think a lot of people have heard that from friends and family. And so I want to talk about that a little bit. And so I purposely made this example less than 1%. And I'm just going to show you, okay, in this situation, they're saving 0.5%. They're going to lower their rate from 7.5 to 7%. What does that do? Okay. So let's just assume that the starting loan balance is the same as where their loan balance is right here. Okay, so that 294, 254 is going to be that new loan balance. And now with the refinance, it might start back over at a 30-year term. So now you say, well, I'm already 2 years into it. Now I'm starting back over at a full 30 years, right? 360 months. Now, the good news, of course, is that the payment has come down. So 1,957.68. So the payment is roughly $140 lower compared to what the payment was initially. And if we look at the remaining interest again, if on this new loan you pay for 30 years, the minimum payment, you don't pay anything extra, you will pay 410,510, which is essentially what your remaining interest is if you don't do the refinance. So you might say, well, that really doesn't make sense. I'm fine with my payment. I don't want to add more years onto the loan. Yes, they can see they're not really adding much in interest. The interest is about the same if they do the refinance or not. So what's the benefit? Does this really make sense? Well, some people might look at this and say, well, I'm saving 140 bucks per month. I have more cash flow. That could certainly be a benefit to a client. And by the way, I like to offer to my clients, so let's just assume for the beginning offer here that this person or the lender came to this client and said, at this 7%, we as a lender can cover your closing costs, right? So not talking about escrows, taxes, or insurance or your prepaid interest. Again, those all have to factor in with how you structure that refinance. I'm just talking about if a lender says, I will cover your loan costs, we'll cover the cost of your appraisal, if we cover the cost of your title, cover the lender fees. So this refinance is not going to cost you anything in closing costs. And we're going to offer you 7%. We'll cover your closing costs. Does it make sense? And again, you're looking at this saying, well, yeah, I don't know. I don't really see a big savings here. I don't know if it makes sense for me to refinance. But let's take a closer look at in some different ways we can look at this. Okay. First, I wanted to show the amortization calculator is just, proving how it would look if you again start off at the 294, 254. Now you have that lower rate at the 7% that you're thinking about taking this refinance for. Yep, you might be starting back over at a fresh 30 years. So let's take that into consideration first, making the 12 payments. So your principal and interest payment again is lower by about $140. So 1,957.68, and the total interest that you're paying throughout the life of this loan, 410, 510, so $410,510. So again, you're not really saving much, if anything, in interest, but your payment's lower with this. Now, I want to show this because this is a question that we want to look into to see if it makes sense. Well, what if you keep making that same payment, right? I just showed you could save about $140 per month with this refinance. And if you just said, no, I don't think it makes sense. I'm going to keep making my payment right now. It's not saving me any interest. I'm going to pay it off in 28 years. Cool. All right. But again, the difference of that $139.96. What if you do this refinance? You take the 7%, but you keep making your same payment of $2,097.64 compared to your current principal and interest payment that you're paying right now. What does that do? Well, let's take a look. We enter that in, and right here where it shows optional extra payments, we're going to show $139.96 being paid per month extra so that you're paying the same amount per month as you already are used to. Well, what does that do? Actual number of payments left, well, that drops now to 294. You save 5.5 years. So basically, instead of, yes, you're starting over at 30-year mortgage, but if you pay that same amount that you're used to paying, you're turning your new loan into a 24.5-year mortgage. You're not going to take 30 years to pay that off. It's going to be paid off in 24.5 years compared to the 28 years that you'd be paying right now if you did not do the refinance. And now look at the interest over the life of the loan. Now the total interest has gone down to 320,771. Well, now that might be something to consider. That might be some savings I'm interested in, right? So again, let's just recap that. So the monthly payments remaining now, if you keep making the same payment, 294 compared to 336 if you don't do the refinance. The total interest remaining is 320,771 compared to 410,553 if you don't do the refinance. So at the end, you do the refinance, keep making your same payment. You're going to save 42 months or 3.5 years in payments and save almost $90,000 in interest over the life of the loan. So you're saving time, you're saving money. You're only saving 0.5% your rate, but you keep making that same payment, and here's where you can see the real savings. Now, it can be tough for some of us to try and keep ourselves on, well, my new minimum payment is, now lower. And maybe again, that could be a benefit. If you see that you're not saving any interest, but maybe that savings of $140 per month in cash flow is more important than the life of the loan savings. There's a couple different ways that you can see the savings. But again, I like to show this to anybody that says, no, that just doesn't make sense. I'm going to keep my current loan and keep making my same payment, you know. So then I show them this and say, well, are you sure? Uh, and I also wanted to show some things to consider because, again, what I like to do with my clients is show them options where we can cover the loan costs, right? Appraisal, title, lender fees. There's some situations where that could be difficult to do, or if a lender brings you an example to say, okay, let's just assume that your closing costs are about $2,500, right? For the, again, appraisal, title, lender fees, before any lender credits are given. That's usually about right. And it can be tougher too with lower loan amounts for lenders to give enough of a credit at times to cover all of the closing costs. So let's just also think of a situation where you're being offered 7%, you're saving 0.5% in your interest rate, but it's going to cost you $2,500 in closing costs. Well, one way to look at it is just to divide the cost by the amount you're saving per month in your payment. So 139.96 is what you're saving per month. You divide that from the 2,500, that comes to 17.86, which is basically a year and a half. So if you pay $2,500 in closing costs, then your break even point is going to be about 1.5 years from the date of that refinance. So that's when you do want to consider what could happen in the next year and a half. And by the way, again, it's called the break even point because you're not actually saving after that year and a half, or that's not the time until you're going to start saving, rather, right? So you want to at least get to that point because you want to keep the loan for longer than that to actually see some of the savings, right? You're not just looking to break even. So these are things that you want to ask yourself. So when you're being offered a loan and a refinance, take a look at the terms, ask if there's any costs, ask the lender if there's any options where the lender can cover some or all of the closing costs. Take a look what that rate is. And then if the break even point, let's say for this one is a year and a half from now, you want to ask yourself, well, do you see yourself, do you have any plans to sell the property in the next couple of years, maybe? Do we think that rates are going to continue to come down? And if they are, if we're hopeful that rates are going to continue to come down, you want to leave yourself open to the possibility of refinancing the next year or 2 years down the road, which again is a great point to what I was making before, that I like to show my clients a no closing cost option for the refinance. Because if you do refinance right now and you're not paying any closing costs, well, guess what? If the rate drops another 0.5% next year or a couple years from now, and I can again show you another option where we can help you refinance, cover your closing costs, and show you this example again, those are the questions again that you want to ask yourself. So again, it's not always possible for lenders to cover all the closing costs in every example, uh, but it's at least worth asking that question because in many cases, there are going to be options where the lender can offer a lender credit and you can do a free refinance. And then that makes that break even point almost obsolete, right? If you're not paying anything in closing costs, you could have this loan for a year. You're going to be saving over that first year if your rate's lower. And then you still leave the door open to say, okay, well, what if the rates drop again next year? Cool. Let's do another refinance at that point. Look at those options again. See if there's another no closing cost option again that next year. So I want to go through this again because these are the main things that you wanted to take a look at, right? There's other factors, as far as, okay, if you are paying closing costs, do you roll those into the loan? Do you bring those out of pocket into closing? Same with the escrow account. If you have escrows for taxes and insurance, a lot of times you might not be able to transfer that account to the new loan. So you might need to set up a new escrow account for this new loan, which could either mean adding it to your new loan balance, which makes your starting loan amount higher, or you bring that money into closing out of pocket, and then after closing, you'll get your other earnest money back too. You can have the opportunity to skip one or up to two payments during a refinance. There's a lot of different ways that you can structure this. Also in Wisconsin, you're allowed to get $2,000 cash back at closing and not have to call it a cash out refinance, right? So many different things to consider when you're looking at a refinance and trying to structure the refinance. So a good loan officer should be going through all these things for you too. Again, the purpose of this video, answering the main questions. Okay, based on these new terms, does it make sense? And if you say yes, well, then let's look at these other, nuances that and ways that we can structure that refinance together to see how you would like this handled, and what your main goals are with this refinance. So I really do hope that this was helpful for everybody. And, I should have mentioned too, of course, this is talking about rate and term refinancing. I will at some point here in the future create a video where we're going to be talking about doing a cash out refinance and showing some options to say, well, if you have some other debt that you're looking to consolidate and pay off, what are the factors to look at to take cash out of the property? You're paying off your current mortgage, but also looking to pay off some additional debt too and consolidating that. So this is just, rate and term refinancing, and talking about these different things. So hopefully that was helpful. If you have any questions, of course, you can always reach out to me here anytime. Again, my name is Dan. Thanks for stopping by. Hope you have a great day. I'll talk to you again soon.